Alright.
Alright, you can go, man.
Hey, what's up, guys? It's Mike Ford here from M to M, and I wanted to do a video that's a little bit different from the other ones. It's talking about penny stocks, so I'm going to branch away from the content I'm telling you here to talk about penny stocks. A lot of new investors love penny stocks, and I love penny stocks too, right? But the problem with penny stocks are that whenever you get a penny stock and you see that the percentages go up, SEC is not going to tell you that there was a such thing as a split or reverse split. So let me go ahead and write that down real quick. All right. So check me out. There's two different things out there, right? There's a split and a reverse split. And whenever you're talking about a split, you're talking about like a big company like say Apple or something like that, and they're positioned at about $700 a share, right? So we're looking at $700 a share. That's a little too expensive for the average investor, right? So, how do you get in? As a company, how do you get more investors? The way you do it is through a split. And most times you want to get your split to be around $100. So if I was Apple or whatever this made up company is, then what I would want to do is I would want to do a 7-to-1 split. So 7-to-1 split is going to do this number. You're going to take this stock down $100 per share. All right? So for that person, whoever had it at a $700 is going to have $100 times 7 across 7 platforms. All right. So that knowing that information is really good because that lets you know that the company was positioned at $700 per share, but then they dropped down to $100 per share, and now at $100 per share, whoever had that big share is going to have more shares, but they're going to have it as far as $100 times 7. All right. Now, I'm going to do a separate video on splits and reverse splits. I just wanted to get the information out there for this one as far as reverse splits, because reverse splits is what we're going to talk about today. All right. Whenever we're looking at a penny stock, right? SEC says that you have to be above a certain price point in order to be a part of the SEC. What is the SEC filings, right? What are they? They're considered the NYSE, the NASDAQ, S&P, and there's several more, right? In order to get in position to actually stay in there where you're getting in that realm, you have to be greater than $1, right? And your penny stock is probably sitting somewhere around 50 cents. All right, 50 cents per share. You're going to get penny stocks that are wanting to get in with these NASDAQ, S&P 500, and NYSE. They're wanting to do that. So how do they do that? This is how they do it. If they position themselves and they say, all right, guys, this is you. You can say you have, let's say 12,000 shares. Let's just do that. 12,000 shares, right? You bought 12,000 shares. That's your shares. Now, what they're going to do as a company is they're going to do a reverse split. A reverse split is going to get them back in the black as far as being back in New York Stock Exchange, because they have a certain time period. Sometimes it might be 30 days. And what that means is you have 30 days to get above $1. If you don't get above $1, you're going to be OTC pink, which is pink slips. You know, so you see what I'm saying? So you don't want to be in the red for that long. So how do you get out really fast? How you do it is you do a reverse split. So if I was going to do a reverse split at this company, I wouldn't do a ×2 reverse split, right? Because guess what that'll do? That'll just take you to $1. That leaves too much flexibility. At $1, that leaves too much flexibility where you are going to be in a spot where, hey, you can go below that, and guess what? You're back in hot water. So what I would do is, what most companies do is they do a reverse split of 3.
Why is the pink bad? Why is being in the pink bad?
OTC pink because you don't get the same benefits as being an SEC filing. So in New York Stock Exchange, NASDAQ, and S&P 500 are more notable. They're more looked at, and then more investors are gonna actually go to those stocks rather than the penny stocks, because penny stocks are typically highly volatile. Penny stocks are here one day, they can be gone the next. Okay. So that's why you want to always keep your company in the black, and you want to keep them inside of the New York Stock Exchange or the NASDAQ, and even this S&P. So this is a reverse split of 3. What most people don't see is that what most people see is this. You're gonna see on your stock exchange, you're gonna see, it's actually gonna be a percentage. If anybody's ever seen like a gainer's move or a moving list or a mover's list, what you're gonna see is a 300% gain on this particular stock. Because guess what? You went up 300%. You were at 50 cents yesterday. Today you're at $1.50. It won't tell you that this 12,000, since you divided by 3, you're gonna take that down. All right.
So 400.
So you'd only have technically now you'd only have this. Your 12,000 shares went to 4,000 shares, but most people don't see that. Most people see that your gain was 300%, and if you have triggers and you have something that tells you to go ahead and sell it if it goes above $1.50, then your stocks are going to be sold. And you sold it at $1.50, and most times after this $1.50, if you didn't see it right away, that $1.50 is going to fluctuate back down to about $1.40 or less. $1.40 or less is when you're going to see it and you're going to sell it. Did you make any money? That's the biggest question.
Didn't you make 40 cents?
You didn't make any money.
Why not?
You bought it at 50 cents.
Right.
They did a reverse split. They went to $1.50.
Times 3.
Your shares didn't double. You actually lost shares. So your shares went from 1,200 and it went down here to 4,000. So you still have the same amount of equity here. Same amount of equity. You went from 12,000 shares to 4,000 shares. But SEC is going to see this as...
And then it dropped down from $1.50 to
right, so really $1.40 is what
it's a
would
loss.
It be... At 50 cents, it would have went down to what?
Like 40 cents.
40 something cents, right?
Yeah.
It would have went down to 40 something cents.
And you saw it took a L. Got it.
So if anything, this would have went to 41 cents if it was still there, because you got divided by 3. So this is 10 cents, 10 cents, 10 cents, 10 cents. And that's where you're gonna get it. So most people see this and they think that they made money whenever you see a 300% gain. And the next day, get this is just even worse. The next day, it says 300%. The next day or later in that day, throughout the rest of that trading day, is going to do this number. As this price goes down from 150 to 140 to 130, all it's going to do is change this percentage. All it's going to do is go from 300% and it'll say 220% gain. So anybody that looks at this is still going to think that they're making a lot of money, 220% gain. The only way you're going to know that you really didn't make any money is A, if you knew how many shares you bought initially. B, you go into the SEC filings and you look at the 8K report. The 8K report is going to tell you that they're doing a reverse split on this day and this time. I hope you found value in this, because I love talking about this stuff. I will do separate videos about the reverse split, and I will do a separate video about the split. Stay tuned.